Live. Sorry for the late start here, technical difficulties, but we are finally live and ready to go. Hello, Smart Money Tree Podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. And today I'm joined with my good friend, Doug Hagerin. Hey, Doug.
Good morning, Kirk. Good afternoon, wherever you may be. And I know we were late, and I know everybody was waiting in line. And right now it's the mad rush for just like it was when Cabbage Patch Dolls were there for Christmas. I know everybody's just trying to get in. So welcome. I hope you can get through the skinny door and we can get everybody lined up. So
It's funny you mentioned Cabbage Patch. I'm thinking back to my youth when even the boys were wanted to have Cabbage Patch dolls. And before anyone skewers me for saying dolls aren't just for girls, back when I grew up, they sure were.
yeah,
You did
they're not
have
anymore.
You did not have dolls when you were a boy when I was a kid, unless you wanted to get beat up or made fun of for the next 20 years of your life. But Cabbage Patch actually bridged that gap where all the boys I knew were in line trying to get Cabbage Patch. Like that was like the Bitcoin of of our era. You know?
Yep. And I want to insert that in the middle of that, just similar to the Cabbage Patch craze, there was the Beanie Baby craze. And I tell you, Ty Warner, the founder of Beanie Baby Tie Company, is my entrepreneurial hero. This man made the greatest financial moves in the history unemotionally. He had this toy that was becoming iconic. People are collecting it. People are selling it. And right at the height, he sold out and became I think he sold it for, I don't know, $4 billion, $5 billion, walked away. Beanie Babies literally crashed in value within months of it. It's the greatest selling at the hype story I've ever seen. He's probably looking at all these people going, you know what? I don't get it. It's bag filled animals. I'm strike. It's right up there with the Pet Rock and Chia Pets.
Hey, don't make fun of the pet rocks, Doug. They have personalities too and feelings. So
And they do have feelings, and they always feel pressed upon. But they are okay. That's a geology joke. But that being said, pet rocks are still around and they still sell.
it's
So does
crazy.
Chia.
Yeah, it's crazy. I don't get it, but it every era has their Beanie Baby. They have their Cabbage Patch. Every era's got it, and I'm trying to remember what it was when my kids were kids, where there was something that they all had to have, and it's always something. It's just don't make enough of it, and we need it, and like if I don't have it, I'm gonna cry, and it's like God, like no wonder parents lose their mind every single day because kids they demand it, and if they don't get it, the world's going to end. I'm like, okay.
Well, that'll be a good segue for what we're going to talk about today, because the marketing and the media, right? And push. I'll just leave it this. Ty Warner's net worth as of August 2023, still $5.8 billion. He was 477 on the billionaires list. He's my hero here. I know, just want to bow down to Ty. Anyway, we can move on.
It's all good, Doug, because when I look back at this and I think, well, of all the people, what was it? Die Hard was there was a quote where the guy was like,
Christmas movie.
I just want to sit on the beach and earn my 20%. And I'm thinking, like, 20%? Like, this was in the 80s, right? Like, this was back when 20% was normal. Really? Yeah. Like a bearer bond for 20%, tax-free, sitting on a beach? That sounds pretty good. Why would a guy with a few $1 billion want to do anything but that? But anyway, I digress. So we're gonna get started. Doug has been a fiend this week. He sent me more charts than I know what to do with. So I'm gonna try to get through some of these. But before we begin, I do want to point out a few things. And I want to share my screen because Doug was nice enough to send this. And I thought it was hilarious. And this is CNBC. I don't know if any of you who recall last week, or actually, no, it was this week. It was earlier this week, wasn't it?
It was earlier this week. Yep.
Yeah, it was on. Yeah, it was on the 13th. Right, so it was Tuesday. And if for those of you who are listening, it says in big bold letters with red, market sell-off. Now I think the index was down like 1.5%, and the humor of the theme was this: is that we haven't had a down day, like a relatively large down day in a long time. And so the first down day, they make it sound like this has been going on for weeks. The market's selling off. It was a single day.
It was like
And it wasn't
14
even
straight weeks of up growth in the markets, right?
and it
I mean,
wasn't
it's been
even
incredible.
yeah, and it wasn't even big. It was like 1%, 1.5% down day. It wasn't even like if it was 4%, I'd say, okay, that warrants a banner. But a 1% down day? Come on.
Back in the 1980s, 90s, 1% was a big move in the markets. And again, the value of the markets were a lot smaller, so 1%, again, still percentage, right? But we didn't see days like nowadays. 1% is a sneeze. I mean, these markets are, I don't think people recognize how, even though the markets have been going up with significant tear since since the Great Recession, with very few blips in between. I don't think people recognize how much more volatile the markets actually are in the current era than they used to be. We're not getting in the weeds about how market makers used to work and how to stabilizing the values of stock shares and things like that. But and volatility is not a bad thing. A reminder that volatility does not mean the market is imploding. Volatility means the market is moving. And so volatility means good and bad, right? But markets are, the markets over the last, 15 years or so are wildly more volatile than they ever were in history. And that is because there's so many more forces, so much more access, so many more other variables that I'm not going to get into. 1% is nothing anymore. We see those days all the time. It's crazy.
Yeah, it's interesting, and I'm going to share this. I'm going to share this chart because there's something really interesting here. You know, we're not unique in the world in that we are domestic centric when it comes to investing. Every country is more likely, the investors are more likely to invest domestically than they are internationally. Always the case in every country. We're not unique in that way. It just so happens that the U.S. happens to be one of the better places to invest and has been for the last 15 years. But it doesn't mean that it's necessarily the case. Now, if you look at this, I'm going to see if I can get a screen share here. I'm going to do here we go. I'm going to share this.
And while you're bringing that up, I'll just say that what you're talking about is really, it's loyalty to your own nationality and understanding. I've had a gentleman who was an Indian gentleman who about 2 years ago was saying, I want to invest in India. India is going to be really successful, going to be the next hot market. And I think one of the charts that I found and gave earlier this week, week or last week, is India has been one of the hottest investments in the world for the last couple of years. So, and again, he knew it because he's Indian. He's from India. It's an area that he understood and believed in very heavily. So,
all right, here we go. Yeah, I think, and that's actually really interesting because I've noticed a lot of our Indian clients, a lot of them invest back home in large part because what's interesting about India is if back when we had like 0% rates, they were getting like 6-7%, right? Which is great, right? And other countries actually had some high rates too, depending on. But there was some. I didn't understand the full nuance, but basically, there's something that I couldn't go invest 6% in India. Like there's something about being a resident or a citizen there that gives you special rate. But that being said, so I want to share this chart because we're talking about international, which is how many people are talking about Japan right now?
Oh, interesting topic.
How many people are talking about Japan? No one.
Crickets.
No one. Not a. There's only
Kirk,
one.
I know someone. You've
yes.
talked about Japan quite a bit in our show.
Yes,
for
I
those
have.
that are listening.
Yes, I have. But let's keep it off me, Doug. I'm just. But no. In all seriousness, though, I mean, Japan has been this interesting topic for a long time because they've been undervalued. The stock market's gone down for 23 years, I think, in a row. Not in a row, but the trend was 23 years, and only recently it started to break back out. In the last like seven or so years, it started to break out. And actually, oddly enough, I'm going to share this. If you notice, the Nikkei is back to all-time highs. Wow. The Nikkei, which in the look, I mean, I think it was 1990. This chart looks a little weird, but 1990 hit all-time highs in the Nikkei. And then, as you can tell, went into recession for a long period of time up until recently. And now it's touching all-time highs. Fascinating. How many people are talking about Japan? No one. Not a single person. I've heard one company, and they've been sending out this research on value investing in Japan for a long time, which leads me to believe that, okay, well, a broken clock is right twice a day. So it's hard to tell whether they're right or just lucky. But it's actually one of the bigger, more well-renowned institutional firms. And so I've been trying to get them on the show for a while because I've known about Japan being a great value and just not being respected by markets. Now, the funny thing here, and this is where the arrow comes in, they've had 2 negative GDP prints in a row. And in Japan, that means they're in a recession.
That's what cracks me up. I was waiting for it.
So Japan, which has had a rocket ride since it looks like the late aughts up until recently, is in a recession, and it's at all-time highs right when it hits a recession.
Yep.
How coincidental is that? Is it going to keep going higher? I don't know, but it's very coincidental.
It's hysterical. They finally produced the best numbers and hit their all-time highs in a recession.
And the funny part is, if they were the US, then the investors would be like, great, you're going to start printing money. So we're definitely going to take it to new highs. And so this kind of brings us all back to really the point here, which is we're in a different paradigm. We're in a different era. The rules have changed. Things have changed. So the rules that you think have applied and you think do apply may not apply anymore. Because if Japan, if the Nikkei is hitting all-time highs in a recession, then it's safe to say that there might be more upside from here. Now, we don't know. I usually like to wait till it breaks all-time highs because until it does, it's a big ceiling that you have to break through, right? Remember they talk about the glass ceiling in corporate America? This is a cement ceiling. It's not glass, because what typically happens, especially in charts like this, I'm using this chart just because I just happened to see it. But if you look at charts like this, there's they call it a rounded bottom. So it like curves and then starts trending up. Now, if it breaks all-time highs, that's very bullish. And what it means, if it's breaking all-time highs, then the upside is enormous from here. So keep that in mind. Also keep in mind that that's a cement ceiling. It's been there for a while, which means that it could bounce around. It could break it a little bit. But unless it shoots higher and stays higher, I'd be really cautious at this point. Now, because of the fact it's a recession and we're laughing because it's coincidental, but it's at the same time, it's indicative of where things go. So if things keep going higher, and by the way, just note that 2 quarters ago, the numbers weren't very good in the GDP number, and this quarter they're only slightly down. So to be fair, yes, technically it's a recession. Like technically, our country had a recession last year, and I think the Biden administration decided it wasn't. So not that that's their job, but they decided, oh, it's not a recession. So who the heck knows? I mean, these government numbers are always flimsy, no matter which country you're talking about. But I want to point out this example. No one's talking about it. We're reaching all-time highs. From a technical perspective, it looks very strong. And there's really nothing you can do here until it breaks. Once it breaks, then you should consider adding this to your portfolio. And I'm not saying you should add this. I'm just saying as an example, and illustrative purposes and all that for compliance purposes. But if it breaks out, this would be an example of one you'd want to buy. And if it breaks out and then comes back and breaks down, you want to get out, right? So there's a stop loss built in, because if it breaks out higher, that's bullish. If it actually breaks out higher and then it's a bull trap and actually goes lower, what that means is that's really bearish. What that means is that it's a fake out and it's really not going higher. It's going lower, and get out at all costs. Just get out. That's technically, whether we're talking about the Nikkei or ABC stock or whatever it is. They're all technically these are the indicators. So this is a potentially strong chart, which it's strong once it breaks out. The ceiling could be quite strong. We'll find out because it looks like it's accelerated pretty quickly in a recession. So just something to keep an eye on. And one last piece. The fact that nobody's talking about this is probably the most bullish argument you could make about this index. And here's the reason. And this is something that most people don't talk about. So you're hearing it really on this show. Probably won't hear it many other places. The reason that something like this is bullish, and this goes for any asset, doesn't matter. This is just an example. So no one's talking about the Nikkei. I'm sure people in Japan are talking about it, but nobody in the US is talking about it. And we are one of the biggest, most liquid financial markets. So it matters what we think. Only for that reason alone. So the infrastructure of the system is such that there's money floating around looking for a home. As I don't want to misquote Jim Cramer or even quote him, but the money has to go somewhere. So if it's selling out from stocks and everywhere, it's probably going to cash. If markets are going higher, it's probably coming from cash and going to stocks. So my point is no one's talking about Japan. So once people start talking about Japan, then the big money starts to go in, then bigger money, and then the retail people come in last, and they keep pushing it higher. So if no one's talking about it, it's actually bullish because that means no one is putting all of their money in. But once it becomes cocktail conversation, that's when retail money comes in, and Wall Street calls it the dumb money. The dumb money comes in, and it just floods the market, right? And it just pushes it up higher and higher and higher. And the Nikkei is not as big as the U.S. markets and others. So if you had $1 trillion, a few $1 trillion flooding the market, that could actually move the price. Now they're not tiny; it's actually a pretty big market, but depending on how much money is sloshing around, that could actually continue to. Remember what happened with Tesla? Tesla was in a range and it broke out and it just skyrocketed once it broke out of that range. Same thing, right? This is in a range. If it breaks out, it could skyrocket. It might not. I have no idea. But it's something to watch and it's something to be aware of. And so when you're looking at something like Japan has actually been a value investment for quite some time. That they had low PE ratios, the companies were undervalued, a lot of the companies were strong. And I'm saying this in general, obviously there's good and bad, but in general, they've strengthened, even though the country, the financials of the country itself were not so strong, but the corporations were actually doing well. So just something to keep in mind, something to watch. Europe is kind of at a high end. I'm a little more concerned about Europe, but Japan has certainly shown a lot of grit and tenacity in the resilience for going higher, and I think we may see that more. It may bounce around a little bit from here, but if it breaks out, I'd definitely be watching this closely. So, Doug, what are your thoughts?
Yeah, so a couple things. First of all, I think it's a good reminder of the fundamentals investing versus in technical investing. So what you're talking about obviously is what a lot of technical traders are looking for. They're looking for these ceilings, they're looking for breakthroughs and trends that will lead into all sorts of different terms I'm not going to get into, and patterning. It gets a little bit into the weeds. At the same time, like you said, how does this trend lead in terms of whether or not it's a greater investment or not? There's a lot of things that, Japan still deals with an extremely aging population. And of course, they've really had significantly reduced birth rates. So again, what are the impacts fundamentally there on Japan? But I mean, if you think about Japan companies, they're still dominant leaders in a lot of different markets. I mean, if you go to the auto industry, most people will go back and still tell you the Honda and Toyota are probably the two most reliable sustaining value manufacturers that are out there right now. The other thing that I think that this leads to two things is this is where a lot of chart crimes occur, is because you're seeing where that chart ended, and this is where a lot of people will take the charts and make these arbitrary opinions or arbitrary patterns that they will then justify and create to show where it could go and how that's going to lead to these guaranteed results. And so there's things we look for is, And they didn't do it in this chart, but there's other charts we've got where they show that very clearly. It's like, hey, look, because it did this, look where it will be. Those are things to be careful of. And here's an excellent one that we'll come back to. And then, of course, the last thing on that is also having to do with what you were mentioning about the fact that it's quiet. When it's quiet, there's not only is it the retail dumb money coming in, but also a lot of times when you see a lot of noise around it, you have to, like everything you get marketed to, you have to ask yourself, who's behind the messaging? Now, I'm going to segue to Bitcoin for a second, because we have a wonderful image in there of showing a recent promotion that popped up where they were pushing Bitcoin using drones. Again, the push. Now, is Bitcoin poised to break out and go to $100,000 plus? I don't know, right? But the last time we heard this much momentum and this much noise about it, they had a lot of people jump in. Just saw someone a message that someone posted. There you are, right? It's in your face. Who's paying to put that money out? Now, this was put out, I think, by one of the fund companies or the ETFs, right? So but how do they make their money? They're making their money by getting you to follow those inflows. Remember, though, these are things that are concentrated holds by lots of people who, the last time it got this popular, all of a sudden Bitcoin reversed and a lot of the late entries lost their shirts. I just saw something recently where someone just said, hey, I just took out a $50,000 loan to buy Bitcoin. Okay. Maybe could be the best decision of their entire life, but it could also be what leads to ruins. Again, what is nice when you see something developing and growing organically without that hype, it means that there's unlikely that someone is pushing a messaging there that could potentially be more in their favor than yours. So just something to remember.
Yes. So I'm going to show a few chart crimes. It's chart crime time. We're going to come up with some good graphics here for the video in the future for chart crimes. But I saw a few of these, and I wanted to show them because I see this stuff a lot. Doug sees this stuff a lot. And here's an example I saw, which is comparing the S&P 500 now versus 1929. And for those of you who don't remember, 1929, there was a tremendous crash in the markets. And if you look at the chart, you're like, wow, according to them, there's a 0.94 correlation. And a correlation of 1 is identical, right? So if it's 0, it's not at all. If 1, it's identical. If it's -1, it's inversed. This is pretty darn close to 1. And if you look at the chart, it doesn't look that close to 1, but regardless, I don't know how it got 0.94, but that's what it says. So anyway, as you'll notice, this happens to be right at the very peak before it started to drop. And of course, they're comparing February 14th to August 7th of 28. I'm sorry, this was, I don't, yeah, whatever it is, this is not lining up in the same way. So they're comparing a year and I think it looks like 14 months, like 13 and a half months to, I guess it's similar enough. But if you look at the time frame, it looks like they just kind of took a chart and just said, oh, here it is, and it might crash. So we've seen a few of these this week. I'm going to show you another one too. There's this one, which is, it's not really a chart crime, but it's something where people look at the probabilities for the month and they say, oh, well, late February can be tricky for the bulls. And it shows basically the 15th of February is when it goes down. And the beginning of the month is when it goes up. Now, I don't know, in recent history, I've noticed that the beginning of February is when it goes down, but regardless, they did the data, so I'll just assume it's correct. But the story that they're trying to convey to you when they show you this is now's the time to get out. They might not say that, but what they're saying is, wow, now's a good time to get out. It's the 15th, and this came out on the 15th, by the way. I think they did it on the 14th, and it came out on the 15th. So the story they're trying to convey to you with this chart is that the 15th is the time to get out of the markets. Well, I don't know if it's the right time to get out of the markets or not, but in my standpoint, I think it's a very poor way to make investment decisions. It just is, right? If you're a buy and hold investor, that's horrible. And I won't say the name of the people who put this together, but they're dealing with individual investors. And you're telling them to get out of the market when you're more or less a buy and hold investor. That's terrible advice. Now, if you're a trader, right, if you're trading in on the market and you're looking for trends and stuff like that, great data, right? Assuming it's accurate, right? It's great data, right? And you want that. But I'm pretty sure their clients are not that. So, how responsible is that chart to put out for your customers or clients that's basically telling them to get out when these people are buy and hold? That's stressful. That's bringing anxiety. It's really I wouldn't want to see that as a client. I get scared, be like, I don't want to work with these people. But that's a different story. Here's another one. It kind of shows, and this is just a random chart. It's basically the net savings as a share of gross national income. Basically, what they're saying is people are saving less, and it goes into recession. So if you'll notice, there's recessions in these years, and by the way, here are the times where it went below zero. Oh, below zero has ended in recessions. Okay, but there are also two recessions before this that didn't go below zero. So how accurate is this? So I wanted to show this as it's not so much a chart crime, but it's more illustrative of what we see. There's a phrase I use humorously all the time, which is, yeah, it's a great indicator. It's predicted 10 of the last 3 recessions. And so what frequently happens is when people come up with indicators, it's like, wow, this indicator has picked, the last 3 recessions, or every recession was picked by this indicator. And yes, it may have picked the last 10 recessions, but it also picked 20 or 30 or 50 other recessions that never happened. So how accurate is it? It's not just the accuracy, but it's also the inaccuracy or the negative of the equation, right? Because most people look at the positive, like how many times has it been accurate, but also you want to look at how many times has it missed. And most charts or groups that are putting out research, they don't show you the man behind the curtain. They don't show you what was missing. They're what we would call a half truth, right? The half truth is when you get something that sounds true. Academically, it sounds true. It's mostly true, but it's not 100% true. And the danger behind that is that people think it's true and they treat it as true, even though it's not. And it's actually one of the forms of persuasion or manipulation that people use. So if you want to know if people are manipulating you, look at that. We talk about in the show a lot on this indicator, and says, oh, if you missed the 10 best days, you would have significantly underperformed the S&P by like 10% a year. Yeah, but if you missed the 10 worst days, you would have doubled the performance of just buy and hold. So they're only showing you half the picture because they're trying to convey a story. And we talk about story on the show a lot because if you're getting research, if you're getting a sales pitch, it's a story. It's not inaccurate. Maybe it's accurate, maybe it's not. I don't know. It depends on the story. But it's not necessarily inaccurate. But you need to understand somebody's telling you a story. And this chart is a story. And the story is, wow, we're below zero, and it's ended in a recession, so we're due for recession. And we show these charts a lot. Oh, wow, this is a bad indicator. It's going for recession. Maybe, but also if I look at this, it lines up for when technically we did have a recession and Biden said no, it wasn't. So maybe it is accurate. I don't know. But it's still going down, which isn't good. And we still haven't had a serious recession, whether you agree the Biden recession was a recession or not. It wasn't a serious one because the economy is still strong and the stock market's still strong. So is it a recession? I don't know. I'm not smart enough to know that because I'm not in the weeds like the government people are to come up with these numbers. But I do know that there are a lot of indicators that indicate that we are heading towards a recession. If we're not in one already, then it's going to be close. So, I think looking at these will help you become smarter investors because what you'll notice are the things that are being used to manipulate you and versus the things that are actually accurate. And here's another one. I see these a lot. Oh, this happens to be on interest expense. Sometimes it's on outstanding debt. Anytime you see a chart that says outstanding debt's going through the roof, we're going to have a crash and a recession. No, we're not. That is not an indication of a crash. It's not an indication of a recession. If it is, it's coincidental. It has nothing to do with it. We could paper over money for years to come. I would say another 10 years, we could paper over all our mistakes and keep printing money, and it's not going to severely affect our economy. It'll affect it, but severely, not so much. Now, this is actually important. Interest expense in US public debt. So if you think about, like, let's say there's $1 trillion in our budget, right? And we've got 300 billion is going to interest expense, 300 billion is going to defense, and 100 billion is going to miscellaneous, and like 300 billion is going to like operations, all this other stuff. So, and social security and all this crap, right? So if you look at it that way, right, you've got a third going to interest expense. This is money that doesn't go to our benefit. This is money that the baby boomers have spent, and they spent it on themselves selfishly. And I'm a little down on baby boomers because we've got probably two presidential candidates, both of whom are 80, are going to be 80 and shouldn't be running based on age alone. Has nothing to do with their capacity. I know someone will get mad at me. Just age alone, they shouldn't be running. They shouldn't be in the race. But I think the baby boomers have held on to power a lot longer than they should have, in part because my generation, the Xers, have decided we don't want any part of the system. And that's our fault. We didn't take the power away from the boomers. So they're holding on to it, but we let them do it. So it's our fault as a generation for letting them do it. And frankly, our generation is leave us alone. Just leave us alone. Go about your business. Do whatever you want. I don't care. Just leave me alone. That's our generation. So in part, it's our fault, but at the same point, it's we could have saved it, and we kind of let it happen. So anyway, the point is it's showing that interest expense is going through the roof, right? Now, this is a bad thing because the higher it goes, the less money that goes to spend on you, me, everyone else in public, expenditures, whatever it may be, whatever the government decides to spend it on. That means less money is going to us. It also means that more money is being borrowed to spend in the budget, which means this number keeps going higher. So it's a negative reinforcement loop. We borrow more, spend more. It's like, imagine this. You have a credit card and it's like got $10,000 on it, and you have to pay, I don't know, let's say you're paying like $1,000 a month. I know that's a really bad math example, but let's say you're spending $1,000 a month on that, right? You got $10,000 and you're like, well, I can't pay my bills this month because that 1,000 is going to the interest, and so I can't pay my rent. So I'm just not going to pay the interest. Better yet, I'm going to go get another credit card. I'm going to use that to pay for my additional. I'll pay for the $1,000 plus everything else I need. So I got another card. There's another 10,000. Then another card, another 10,000. Over and over until I got like 100 credit cards, and I got like $10,000. I'm sorry, it'd be whatever. My math is off. Like $100,000 in debt, and now I got overwhelming interest, which I can't pay. And so I just get more and more credit cards. That's effectively what the government's doing. Now, you and I, as citizens, as individuals, we cannot keep getting credit cards to pay for our expenditures, because at some point the credit cards are like, yeah, sorry, you're getting cut off. You're irresponsible and you're not getting any more money. At some point, the credit card companies do that because they're a business and they have to make money. So if everyone just took all their money and spent it, then they'd be out of business. So them being smart business people, they say, all right, you're cut off. You're not getting any more credit from us. Or we raise your interest rates up to 50%, which ensures you're never getting credit again and you're never going to be able to pay it back. But the government doesn't have that. The government can borrow as much money as they want, and they can lower rates if they want, because the Federal Reserve basically does whatever they want. So they say, oh, we're going to lower rates to zero, and then the government refinances all their debt at zero, and you and I can do that as well. But in the meantime, we can't go print more money. The government can. So the problem with this dynamic is that we are in a negative reinforcement loop that we cannot get out of. At this point, the numbers are such that unless we decide to forego all of our defense spending, a lot of our, let's call it public good, right? The things that the government's spending money on that go back to us as citizens, as our benefit of paying taxes, that sort of stuff, like that's going to be less and less, and this is going to be more and more. And at some point, they just say, to the heck with it, we're just printing money and we're just going to do whatever we want and F the budget because the budget doesn't matter. And that's where you started hearing this MMT stuff where like budgets don't matter, deficits don't matter, debt doesn't matter. And in essence, it doesn't until it does. So they're kind of right, half truth until it matters. And when it matters, it's a disaster. Like this is when we become a banana republic, which we're kind of already on the way to. And our money's worthless, and we have a disaster of an economy because the devaluation of the dollar becoming close to worthless. We become Venezuela and some of these other countries like Zimbabwe, where they had hyperinflation. So that's down the road if we continue down this path. It's not in the short term, though. I want to be very clear. Most people think this is going to happen tomorrow. It's probably going to happen 10, 20 years from now. Like, it is not close to happening today. But this is a sign that we're on the path. And unless they just take this and light it on fire, it's not going away. So just be warned that this is in our future if things don't change. And I don't see them changing, Doug, because the politicians want to get reelected. And the last thing, if you don't want to get reelected, the first thing you do is decide to be responsible fiscally. Hey, I want to turn this country around. The first thing I'm going to do is stop paying out Social Security. I'm going to stop paying out Medicare, Medicaid. I'm going to stop paying out welfare. I'm going to stop doing all these things, and we're just going to pay down our debt. Yeah, we're going to get you out of there the first day. Look what they did.
Read my lips. No new taxes.
Yep.
How did that end up faring for George Bush?
Yeah,
so it's just once he reversed on it, it killed him.
Every single person that's tried to be responsible has gotten booted. So I'm very interested to see what happens with Milei, who got elected, who's more of a libertarian. And that's part of his promise is to become more responsible fiscally. So I'm curious to see how that goes. Because the big challenge that we have as a country and most countries have is when you try to become responsible once it's too late, you're really not making headway. The things you have to do are going to be painful, and no one wants to take the pain. As I forget the guy's name. He's a Chicago Democrat. He's a what was the guy's name? Anyway, he said, never let a crisis go to waste. And the point is you can only really make change in a crisis because change is hard and it's painful and no one wants to tighten their belt strings. Nobody does. Imagine this. You're in a recession, right? We say we go into recession. Everybody's having a hard time paying their bills. And the government's like, yeah, we're going to stop our social services. We're just going to stop them for 5 years. So screw you guys. We're going home. Like, we're going to pay down debt and you all can fend for yourselves. How's that going to go? It's not going to go very well. So it's, when people talk about change, it's a pie in the sky kind of change. I mean, I'm with them. I want change too. But in reality, in order for change to happen, you have to be willing to accept a lot of pain. And I don't know anybody who's willing to accept a lot of pain who's also benefiting from the government. And at this point, most of us are benefiting from the government. Most of us. So how's that going to work, right? Social Security, you're going to cut Social Security, you're going to cut Medicare, Medicaid, you're going to cut, welfare, you're going to cut services, government services. It's not going to happen. So, are we going to stop becoming the policeman of the world? Like all these things that require money, that's not going to stop. So while it's an idealistic standpoint to want to become responsible, I just don't see how it happens. Or I see how it happens, but I don't see how it actually happens, right? Like, oh, I see exactly. We do A, B, C, and D. And then these people get kicked out and the next people come in and they go back to the old ways and they keep printing money. I just don't see how it's feasible. Like, you have to totally wreck the whole system to actually make this happen. And nobody wants that. No, even the anarchists don't want to wreck the whole system because that's literally anarchy. And that nobody wants that. Like, that'd be horrendous. It'd be like The Purge, the movie The Purge. Like, we don't want that. So you have to think about, the ramifications of change. And this happens a lot. I'm just going to say this and give it back to Doug. But if you think about change, right? Everyone wants change. No one wants the downside. And this frequently is the difference between the parties. One party wants one thing. The other party wants something else. But actually, they want the same thing. They just look at it from different lenses. So their solution to solving the problem, they agree on the problem's a problem, and they agree that it should be solved. What they don't agree on is the solution to solving it, right? And one party tends to have a little bit more hard-nosed approach, and the other party tends to be a little bit more oh, we want to protect the people kind of approach. The problem is if that doesn't align with human nature, then it'll fail. Because that's like saying, oh, well, we shouldn't, like California, we shouldn't prosecute people for under $900 of theft. So what happens? You have bands of thieves coming in and blanketing the store and stealing everything that's not nailed down because no one's going to prosecute them. Oh, who would have saw that coming? I don't know. How about the people who said you should enforce the law? Like, so, I get why things happen, but if you're not thinking 2 steps ahead and thinking about the unintended consequences, then anything you do to solve a problem is going to fail. And I use that example, but it also applies to the other party, right? And like, oh, we should just get rid of the Fed. And they're irresponsible, get rid of the Fed. Yeah, that's a great idea. And then what? Like, what's going to fill that void? Like the free market? We don't have a free market. We haven't for a long time. So technically what's going to fill the void is chaos. And nobody wants chaos. And it means lower stock prices, lower bond prices. It doesn't lead to good things. And for people to say they're willing to accept that, they haven't thought it through. They haven't thought about the unintended consequence of what that leads to. It leads to chaos, leads to anarchy, it leads to, potentially overthrow the government. Like that doesn't lead to good places. So nobody should want that. The problem is there's no easy solution to get there in like small baby steps because we're unwilling to accept small change. Only when there's chaos are we willing to accept change. So I just want to kind of leave with that because I think we all want changes in our country and politically and fiscally and economically. We all want the changes, but we're unwilling to accept the consequences for those changes. And unless you've fully thought through the consequences and you're willing to say, okay, here's what I think is going to happen, but I also know I could be wrong, then you're not a part of the discussion. You're not. You're just making things worse because we have a lot of people who have opinions who haven't fully thought it through. And one side says one thing and the other side says, yeah, have you thought about this? Or like, that's not going to happen. How do you know? We can't know. Like, you don't know the future. So I would just kind of take that to heart because we're going to have an election season coming up in the next, whatever it is, 6-7 months. And we're going to hear a lot of solutions, in air quotes, for those of you listeners, a lot of solutions proposed. And many of them are crap, right? And both parties, many of them are crap. There's a lot of political grandstanding and it sounds good, but practically, it's like Trump saying that he's going to build a wall. He didn't build a wall. He wasn't planning on building a wall. He was planning on doing border security, but you can't say border security because that doesn't mean anything. You're saying you're building a wall and all of a sudden everybody gets fired up. Oh, you can't put a wall up. It'll get rid of my view or whatever the reason is. But reality was he was talking about border security, but you can't say that because that's not sexy. So he said, build a wall. So anything politicians say is a half truth and you just have to take it with a grain of salt. So a lot of that applies to a lot of the stuff we talk about here. And that's why we share these charts so we can help you think about reality better. And so you can make better decisions with your investments and have fewer failures based on information that's not really information, it's more of a story. So Doug, where do you want to go from here? We got plenty of charts to go to. I feel like we're not getting through enough.
Well, hey, that's fine. We got plenty of charts. Plenty of charts to go through, and we can get back to some. Actually, I wanted to give you a little bit of a context on what you said. The quote you were thinking of was Rahm Emanuel.
Yes.
Yep. Although I know how much you love misquotes or misappropriation quotes. So originally that quote has been attributed to Winston Churchill as one of the Winston Churchillisms. However, that turns out to be completely inaccurate. It had nothing to do with Winston Churchill. There is original attributions that go back to originally being stated by Italian Renaissance writer Niccolo Machiavelli. But it's also been repeated or attributed to other politicians ever since. And based on Freakonomics did some research. The earliest that they could find it being used was in 1976. M.F. Weiner wrote an article in the Journal of Medical Economics entitled "Don't Waste a Crisis, Your Patient's or Your Own." What he meant was that a medical crisis could be used to improve the aspects of personality, mental health, and lifestyle. But again, it's been attributed to a number of people. So just in case anybody out there looks it up, and again, one of the first things you do when you Google, it'll pull up Winston Churchill. I knew you'd appreciate this, Kirk. It is not accurate.
I do, and I also want to say this, Doug, that I appreciate you Googling this while we were talking. I obviously bored you to death, so Doug was like, this is boring. I'm going to look up the quote.
My job is to be here to be 3 steps ahead of you, Kirk. So when you're done, we've got the next thing to fill in. So that's
I guess I'm the comic relief then.
Listen, I'm just the lowly assistant. I'm the hunchback at Notre Dame. So yeah, no, I'll let you drive with where we're going on this, Kirk, because I think you do have a number of other charts. So I'll kind of point us in a new direction. I know we're getting near the end of the hour here. So
all right, so I'm going to touch on 2 more topics here. One of them is you actually touched on it earlier in the show, and I want to share a chart, which is how we've been talking about this for a while, is how the market is completely mispricing interest rates. Now, here's a chart. Here's a CME FedWatch tool. And this is basically the probabilities that at a meeting they're going to change the rate to this rate. So the probability of them staying the same, which is the 5.25 to 5.5, at the next Fed meeting is 91.5%. There's an 8.5% that they'll lower it 25 basis points. So that's how this chart. It's just a grid. For those of you listening, it's a grid. It shows every meeting date. It shows the rating ranges. And what I find interesting about this is that this will change all the time. This is as of today, or whenever this was taken. There was no date, but as of today, let's say, this is the probabilities. And so if you're thinking about, are the rates going to rise or fall, and you're using this as a structure of probabilities, I would say the discrepancy between how the market is pricing it and reality is significant. Now, this is not, we'll have to go back to like a month ago. We had a show where we showed one of these, and it was drastically different. It was pricing in like 4 or 5 rate drops for next year. I mean, this one is probabilizing that's going to go down about 1% in the next whatever 10 months. A 33% chance is the highest probability. It's going to go down a full percent. I think that's pretty high. I think that's a lot higher than it should be. It should probably be, maybe, in my opinion, 25, maybe 50 basis points would be twisting my arm. I'd say, okay, on the far side it'd be 50, but I'm saying 25 is probably what they'll drop it, if at all. I actually think the highest probability is they don't drop it at all. But I can see, if things get better, I could see them dropping it a little bit, 50 at the most. But that's not how the market's seeing it. The market's not seeing that at all. There's a 11% chance that it's a 50%. A 50 basis point drop. That's really small. So I bring this up because we talk about it, and I want to put numbers to the page for each one of you for what we're talking about, because we talk about these things because these ideas come out, and then people come up with charts after, and we're like, all right, let's share the charts with our listeners. We want to support what we're saying. We're saying it well in advance of seeing this. But as we point out, like the inaccuracies of the predictions of the market right now are tremendous. And so if the market thinks, wow, we're going to drop rates a lot, and when the CPI came out this week and it was higher than expected, the market dropped 1.5%, which is not that much. But the market didn't like that. And now we're back to our old tricks and games again, where the market just keeps marching higher regardless of predictions. At some point, things are going to get ugly. I don't know when that is, but the fact that it's mispriced, you should be aware of. But also, this is where, if you take Economics 101, there's a concept which is that markets, they're efficient. They're always efficient, right? It's the efficient market hypothesis. Markets are efficient. They're always priced accurately, right? That's the thinking, is that everybody has all the information. So mind you, I'm going to explain some of the assumptions that go into this. And one of the assumptions is that everyone has access to the same information. Well, that's not true. First off, I don't have the same access to Goldman Sachs or hedge funds that spend $100 million in research. I don't have access to that. Also, it's assuming that all participants have the same set of knowledge and understanding of the markets. Well, that's not true either. If you talk to any retail investor, every single one of them is different. And they all got their opinions on the markets, and they're probably all wrong, right? Because they're not living it, right? It's like me going and practice medicine, and I'm going to do brain surgery and assuming I know what I'm talking about. Of course not, right? I don't live that. I've never gone to school for it. So the understanding of it, the efficient market hypothesis, is patently wrong. And this is an example, actually, of why it's wrong. Now, we said on the show that it was wildly mispriced, and we're not the only ones. Other people have said that, but the market itself is pricing it as, oh, they're gonna drop rates a lot, and they haven't. Even when the rates were going up and Powell said they're going up, they still predicted 6 months later the rates are going to drop. So they've been wrong for like 2 years, and patently wrong. And so that presents opportunity. The market has a price. Let's say the price is, I'm just using this example. Let's say the market says the price is 50 and the price should be 75, right? Let's say in my opinion, it should be 75. Well, if the market says it's 50 and I say it's 75, let's assume I'm right for this example. Okay. That means there's a $25 spread between what the market thinks and what I think, which means that if I'm buying that at $50 and I think it's worth 75, I'm going to make a 50% profit on that spread because of that difference in pricing. So that's a good deal for me as an investor. I want to see those opportunities and locate them and say, this is the ideal time, because the market is not pricing it properly. And the market doesn't price it properly. It prices it for what buyers and sellers are willing to pay. But if I'm not willing to transact, I might think it's worth more or less, but I'm not willing to transact, so my opinion doesn't count. The only opinion that counts are buyers and sellers. So take that in mind, that the buyers and sellers are making the decision, not you or I, who are not buying and selling. So the mispricing is real. It has been real for a long time, but this is something you should be aware of, because it's going to continue until we hit an equilibrium where things are a little bit more in balance. I think we're in balance now. The market's going higher. Inflation's going higher. Why the heck would you lower rates? There's absolutely no reason. There's two reasons to lower rates. One, we go into recession. The stock market goes into the tank. Our economy goes into the tank. Good reason to lower rates. Second reason for lowering rates. Inflation drops significantly. We go down to 1% inflation or 0 or whatever it was before that they argued. I know they argued it was like 1 to 2, but I think in some cases it might have been negative. But anyway, you go to a really low rate. That's a good reason to lower rates. If you don't have either of those reasons, there's no reason to lower rates. And yet we have inflation going higher. It's a short trend, but at least at the moment it's going higher. And we have a stock market going higher. If anything, they should raise rates. I mean, I'm not saying they should, but if I had to pick right now, I'd say you should raise them. Now, I think they should stay the same. I think they're actually good with where they are. But if they felt like, all right, things are getting too heated, they should be raising them. The market is not pricing that. I don't know if you noticed the chart. There's no chart that ticks on what's the probability for raising rates. So just keep that in mind with how you're pricing the market. And I also want to point out one other last thing before we give it to Doug to wrap it up, is there's a chart here which talks about active versus passive. This is, we may even talk about this more next time, but we have hit a point where 53% of U.S. domiciled AUM is passive oriented, meaning indexing, things like that, versus active. The higher that percentage goes, the more power it gives to active traders. Not currently, but let's say this goes up to 80%. I don't know where that number is. There's a lot of debate about where that number is. I'm just hypothetically saying 75, 8%. If it goes up to that number, the active traders are the ones going to be driving the market prices. So just something to keep in mind. We're going to come back to this because actually a very big topic, and it's philosophical in nature, because you can't really predict the nature of that, but it's important because it could drive the market in the next 5 to 10 years. Doug, let's wrap it up in the interest of time. I know we're kind of running late here.
Yeah, no. So, I mean, because we're running late, I'll keep this short, but going back to the thing of the chart about predictions. I mean, 3 months ago, we were talking, less than that, we were talking about the 497 rate decreases that they were predicting for this year, which of course, I joke with the 497, but one of the other things I think I might have sent you is, interestingly enough, how quickly that has changed is that now not only have they declined the number of analysts that are predicting a rate cut, they actually now do have at least one group, Citi, that has come out predicting a rate increase. Okay. So, and like you said, it's not moving the needle. Like people aren't listening to the data. And that is an irrational exuberance type of situation. And again, how long will this last? Well, in 1997, it lasted another 3 years, 4 years. So, that's the problem with trying to make predictions. But if you're going to talk about, or if anybody's going to talk about efficient markets, I think the perfect example of how inefficient they are is something that I think most people are aware of at this point in time, is going back to COVID. Now, not to sound politically slanted here, this became very apparent publicly, is that when they were making policy decisions around what to do with shutdowns, simultaneously, many Congress persons and senators were making investment decisions in their portfolios based on the decisions that Congress was about to make. Okay. That right there is the perfect example of inefficient, because the markets were not, there were people that had information that was not publicly disseminated in order to make efficient decisions around the markets that they were able to make on. If one person has that power, whether it's insider trading, whether it's Congress, whether it's, whatever the deal is, if one person has information that is not available to the rest of society, you do not have an efficient market. So the fact that this theory is still touted at all, with all of the evidence out there, is just mind-blowing. So ignore it. It doesn't work. They're not efficient. And the economists that still push it are living back in the Stone Ages, probably having conversations still with Niccolo Machiavelli. So moving on and tying everything together here. Again, inefficiency, college planning. We're over time here. So listen, if you don't want to overspend on college, if you would like to be able to have less stress, if you'd like to have peace of mind, if you'd like to have the resource, I just talked to someone who said, I'm waiting to see what we get to make some financial decisions. So in other words, he's waiting for the stress of going to the mailbox to get surprises. If you don't want surprises, if you want to know ahead of time so you can plan, we have a free tool at procollegeplanners.com. We're actually giving away full access to our software to where you can get behind the curtain, the inside information that you need to make smart decisions. Come reach out to us, check on it, because if you don't have the information, you're going to live in surprises, you'll have more stress, and you'll regret it later. procollegeplanners.com. Check it out, or email us at info@procollegeplanners.com.
Great. Well, thanks for coming on, Doug. We're gonna wrap the show up. That's the show for this week. Thank you again for joining us in Money Tree Investing Podcast. My name is Kirk Chisholm, wealth manager of Innovative Advisory Group. We don't just manage your wealth; we make your life better. You can find more about me at innovativewealth.com, and of course, you can find me every week here in the show. Please remember to subscribe to the podcast and the podcast app of your choosing. You can also check out the show at moneytreepodcast.com. On the website, you'll have access to the show notes, resources, and the archive shows. Also, we're now on YouTube. Please check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a show rating and comment in the podcast app of your choice. Oh, and don't forget, do your own research. We're not telling you what to think, merely how to think about investing. We're also not selling you products or services, so do not consider this advice. If you have any problems with the show, I blame Putin, so please send him an email, express your feelings. If you're seeking financial advice, talk to an oracle, or fortune teller, or maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything, but I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.